I'm going to bring in Walser Wealth Management President Rebecca Walser. And Rebecca, this chart really blew my mind. It's another JP Morgan asset chart. I didn't realize that this was coming on to this great degree because the gray bars, folks, are passive investing. In other words, you get your paycheck, they take a big chunk out of it and they put it in the market. It automatically goes to the hottest names out there. The hottest names out there stay hot because passive investing. All of a sudden, though, active is coming on strong. And you like this, right?
Yeah. In December of 2024, you can't tell this chart, but in December of 2024, about 30% of all ETF buys were into active. And that's when the 7% of just all ETFs is only active. So you can see that it's like whoosh, we're going straight into active. I think, Charles, it's about the fact that this market is almost priced for perfection. Like everything must go right. The valuations are so high on current PE. I'm not talking about forward PE, but on current PE, valuations are astronomically high. If you look price to book, we're at 5.1 with the .com at the high, and we're at 5.3 right now. So active is obviously where people feel more comfortable, or a lot of people are feeling more comfortable. They want someone looking at this.
So it's interesting because with the active investing, we talk about the concentration. I started this segment off with concentration. The mega cap stocks are the most under-owned in 16 years. This is Morgan Stanley saying among actively managed funds. So these active managers, are they sort of adding a layer of discipline for investors who may otherwise just chase performance?
I mean, and maybe it's just too much concentration, and they saw what happened in April, and they're just saying, you know what? Price for perfection is scary. Being at the top price to book ever in the history of America is a little bit scary, and let's try to develop more breadth with spreading it out.
Right. To your point, price for perfection. Earnings season, we're winding it down. One thing coming into this week, we saw where earnings beats were getting clobbered, right? At least twice as much as normal. But right now, earnings beats, I mean, these are misses, rather. Earnings misses are getting clobbered. But earnings beats all week long are getting clobbered. So that goes back to your thesis, price for perfection. But these overreactions at some point start to create opportunities, too, don't they?
They do, and they will. And so, you know, you can always buy the dip, as we like to say. But the fact is that we just have really high valuations. And as AI gets monetized, in other words, as it actually gets used into practical everyday use, that's when we'll really see what the bang for the buck is, and we will get some pullback. We just will. Speaking
of pullback, you like one name that's pulled back here, Snow. It's right between the 50 and 200-day moving average. You like it more for the fundamentals, right?
Yeah, the fundamentals. I mean, this is an AI architecture, basically data cloud computing. And the fact is, it's a deconstructed architecture. And if the rates stay where they are, they're looking for a rate cut. They want, they had 100% year-over-year growth in 19 and 20 when rates were basically 25 bits on the Fed funds. And so obviously high rates right now, we're only looking at 30% growth year-over-year. It's expensive. And they're still in the initial stages of not having a profitable profit margin.
But they're moving toward profitability.
Yeah, they're
I would
moving
assume
to
with a chart
margin,
like this.
And they need cheaper rates. That's
There's
right.
one other name, too, that you said that should do well with or without the Fed. We're going to pull up the chart here. And this is not one that I necessarily follow, EG.
Yeah, Everest is a reinsurer, and it's just the entire insurance industry, Charles. Obviously, they would like long-term rates because they invest on the long term, the long side of the curve. And as long as, keeping their fixed income high is obviously better for insurers.
Broke out through the, I mean, you got to like the risk reward, but golly.
Yes.
Okay. Well, it's good to see one that's coming up here.
Exactly.
All right, Rebecca, you going to stay for the panel?
Yes.
All right. Thank you very much.
Thank
Folks,
you.
Again, I'm going to bring in my Fed Power panel, Gabriela Santos, Daniel DiMartino Booth, and Rebecca Walser. And Danielle, I immediately thought of you because you've been saying that Trump is in a bind if Jay Powell wants to stay. There's only one spot left. Mm-hmm. There might be two spots now. I mean, really, this is serious stuff. Just your initial thoughts.
It is. And actually, Charles, to that exact point, if Cook ends up resigning, then you could actually see Powell incentivized to an even greater extent to stay through January of 2028 because of this, to prevent a quote-unquote stacking of the Fed. Easily, you could push Jay Powell into staying.
I saw you in an interview recently, where you said he's already exhausted.
Exhausted.
Should anyone stay in a position that's so taxing on them and be so disenchanted with that job? Wouldn't he be doing everyone a disfavor?
Mariner Eccles stayed in his position when Truman was strong-arming him in 1948. debate and ended up engineering the separation of the U.S. Treasury from the Federal Reserve, making its independence truly institutionalized. So you can stay on as a Fed governor and still make a difference, even if you're not the chair.
Gabriella, here's the thing. A lot of people are saying that the Fed is not independent either, and no matter what you think or say. You know, you look at donations to political parties, everyone's got ideology. Somehow people have to sometimes separate that from their jobs. But is there even such thing as a truly independent Fed?
The way that we think about it is the Fed is politically aware, but we don't think that Fed members are partisan in their decisions. What we mean by politically aware is you have to be aware of how you're perceived by the broader public that you're making these decisions for. And I think what the Fed has come around to understanding is that there's very low tolerance to actually either cause or allow a recession to happen. And so that's why we think the Fed, as well as fiscal policy, is going to be and stay much more proactive about managing downside risk to real economic growth and unemployment from here.
You know, though, in the eyes of the public, the Fed has never had this low of an opinion. Now, this news will make its way to Main Street News, Rebecca. It's not good for the Fed overall to have maybe someone who's on their a member, doing something with mortgage applications.
Well, of course not. We had people in the Trump administration, the first one, go to jail for mortgage fraud. So, and also, even the Attorney General of New York, going after Trump and one of his real estate documents that the evaluations were inaccurate. So his group and his administration has been attacked exactly on this front. And it kind of reminds me of, watch what you accuse other people of if you're in a glass house,
Let me talk about the next Fed chair, because no matter who it is, according to a survey of global fund managers, 54% say that the next Fed will have to resort to QE and/or yield curve control. Rebecca, you've been saying that no matter what, even before this, that the next Fed chair and the next Fed would have no choice but to do these. I
hope it lasts that long. We've got massive problems even this year, 2025. We have a maturity wall. $9.2 trillion has to get refinanced. That's because Yellen obviously financed a lot of the deficits on the short end of the curve. And now we've got, it has to get refinanced. It's getting refinanced. I don't care if they cut or not cut or how much they cut. They're still getting refinanced at a higher rate than they were initially at, written at. And you've got interest almost 3xing since 2020. It's almost our second largest expense of our federal budget. This is not sustainable, Charles. We are running into a problem with our debt.
Danielle?
I don't know. It's a slippery slope. If you rob savers of $490 billion of interest income, they could easily, people over the age of 70, decide, well, what am I going to do with the 40% of the U.S. stock market that I own? So QE and the zero bound, taking the Fed funds rate to 0%, is not the same equation that it was in 2001 or in 2008. It's simply not.
It's not the magic elixir, at least.
Not if you cause the savers, who are very happy with 3.5% on their cash, to begin selling their stocks.
Gabriella?
It does seem like this conversation is going to continue, though, because even when the Fed starts cutting rates again, even if they end up cutting a cumulative 125 basis points, we really don't think that affects the curve besides just your 1 year and below cash-like rates. So it's really a steeper curve. And as a result, it doesn't really change anything if you're looking out at financing the intermediate to long end of the curve.
Today, Fed Governor Walser, who's considered right now, at least by the betting market, to be a slight favorite to be the next Fed chair, talking about crypto. And this is really compelling to me, Gabriella, because since the election, digital assets have seen such moves and inflows, even more so than gold. Really going back to when the ETFs first bought Bitcoin ETF, but it's accelerated. You can see on this chart. And the Fed's got to deal with this. How will the Fed incorporate I want everyone to weigh in on this, but Gabriella first on crypto, digital assets.
I think there are two interesting discussions they're having. The first one just on cryptocurrencies. I think it goes into their consideration about financial conditions and exactly how much fervor there is in the market. And you can see that with cryptocurrency flows. You can see that with meme stocks. So a sign that actually conditions are pretty easy if people are getting back to that behavior. The second one that I think is interesting that Walser talked about and that I saw in the minutes that many participants had discussed stable coins.
Right.
So much more, very different than cryptocurrency, a store of value, instant payments, cheaper, safer. And that's where it seems like there's actually quite a lot of support within the Fed.
Danielle?
Yeah. Michelle Bowman brought up this point yesterday that there are immense possibilities with the blockchain. Clearly there are. We had a treasury trade on a Saturday and was instantaneously settled on the blockchain. When you think about March of 2020, when the long bond wasn't being bid in the middle of the night in Asia and liquidity was a real issue for the U.S. Treasury market, which is the world's risk-free asset, and the possibilities that are endless with the blockchain to introduce more liquidity, that actually puts the United States on a much stronger footing, and the Fed should be looking into these technologies.
Rebecca, we come a long way from that central bank digital currency. That's out, but stablecoin is in.
Yes, but I think that it speaks to a broader picture of why. Why are all these things becoming so extremely popular? And it's dollar debasement. You know, look what the dollar is doing this year, and look why people are going into digital assets, in the crypto, into the blockchain, into gold and gold ETFs, because they're concerned about the value of the dollar.
All right, real quick, I'm running out of time and they're yelling in my ear. I'm so frustrated, though, with the way we measure this economy.
Oh, God.
Can we find a better way than quarterly GDP? I'll start with you, Danielle.
Let's ask the Canadians and the Germans. They report GDP on a monthly basis. Maybe we can just get a little hint from them, a little playbook.
Rebecca.
I'll go with that. I'll vote for that.
I would say economic indicators, imperfect but essential. And really, we look at a mosaic of indicators. You can't just look at one thing. There's no magic crystal ball. We put them all together.
Well, can we do it on a monthly basis? Should we do it on a monthly basis?
We have other monthly indicators.
We have daily indicators. We have five frequency stuff. Why
That's
are we
right.
dealing with this thing? And what really messes me up with the import stuff, I think the way we do import exports is an imperfect. It does not reflect the true strength of the economy. Anyway, we got to leave it there. Power panel. Gabriella, Danielle, Rebecca, thank you all very, very much. Appreciate it. All right.